In this week's video, we'll review the latest charts and data to help us answer the question, is it time to panic? We'll be moving quickly, so feel free to use the pause button on your video player. Using the bullet points shown on your screen, we talked about the possibility of more downside and additional pain on September 8th and again on September 15th. And market participants did indeed experience more pain during the week of Friday, September 22nd. Thus, in the context of our longer-term objectives, let's kick things off with a previously recorded segment from the August 18th video about areas of possible support. We can double back and review the exact same chart on Friday afternoon, September 22nd. The following slide was covered 8 weeks ago in the June 16th video. And even though the charts looked really good on June 16th, it's inevitable that a give back and/or correction is coming at some point, which means recent weakness falls into the 100% normal and to be expected category, and none of us should be surprised. So relative to the October low, we still have a series of higher highs and higher lows in place. And if we came down to this level, these levels here, and this level here, we would still have a series of higher highs and higher lows, which is the definition of an uptrend. Now, several weeks ago, we said it would be normal and to be expected if the market doubled back to this area here, or even this area here. Given this is the look of the exact same chart on Friday, September 22nd, we really haven't seen anything thus far that's particularly surprising or overly concerning relative to our reason for being in this market. The discernible and measurable improvement that took place between the October low and this breakout in May of this year told us that the longer-term risk-reward profile, with the emphasis being on longer term, that profile had shifted from unfavorable to favorable. And as long as the market holds in, around, or near this band of potential support, and maybe more importantly, doesn't exceed this March low down here, which would represent an important lower low, as mentioned in the previous clip, really haven't seen anything yet that tells us that the rally off of the October low 2022, that rally is in serious jeopardy in any way. Concerns would increase and the probabilities would shift if price moves into this area here, and more importantly, down into this area here. And that may indeed happen. It hasn't happened yet. Therefore, this move from A to B really hasn't done anything to impact our longer-term objectives and/or the rationale for being invested in this market. The S&P 500 is still clearly above the anchored volume-weighted average price line, tied to the 2022 high early January 2022, and price is clearly above the anchored VWAP line from the October 2022 low, which comes in this area in here. And as long as we hold these areas, the expectation would be that the market will eventually right itself and go on to exceed this high here. And thus, theoretically, our account balances would exceed the balances from late July. It's not a prediction in any shape, form, or fashion. As always, we're assessing probabilities based on the charts in front of us. If the charts shift in a material manner, we'll have to reassess those probabilities, and if needed, readjust our allocations. And even if price comes down into this area here, it's noteworthy from Ryan Dietrich. The last 3 times the S&P 500 was down at least 1% in August and September. October was up 8% in 2022, 8.3% in 2015, 10.8% in 2011, and a higher 9 out of the past 10 times going back to the late 1950s, aligning with our longer-term objectives. Also noteworthy, seasonals and historical patterns, pre-election years, we're in one now, typically see some give back and consolidation. That typically lasts for a few more weeks into mid-October, and then Q4 typically, not a prediction, features a strong rally into year-end. A chart like this is not particularly helpful if we can't review it in an objective and unbiased manner. Those concepts equally apply to a chart with positive developments and to a chart with concerning developments. In the context of building the secular trend model, right side of your screen, the chart is dated September 21st. This is a monthly chart with a Bollinger Band based on the 20-month moving average. It's rare to get a strong rally off of a low like this and have your upper Bollinger Band still have a negative slope and to have a center line with a negative slope. Not unprecedented, but rare. Something similar happened in 1989. Why is this concerning? It's telling us that the longer-term trend, even in the context of this rally, is still vulnerable. And that's something that we're going to have to respect going forward. And that's something that helps us keep an open mind about worse than expected outcomes. On the other end of the spectrum, it was also concerning at the end of April 1989 on the left side of your screen. And walking forward, in the context of a lot of concerns about the economy and the stability of markets, the S&P 500 on the monthly chart gained an additional 16.7% before the recession became a factor, reminding us to trade the charts in front of us, even if a recession is coming sometime in the next 24 months. Worrying about it in this context here was not particularly helpful. This concerning look turned into a constructive look. Just reviewed a negative development objectively, and that's the way we should review all of the remaining data in this week's video. Market had another tough week, significantly red. Credit markets have to be panicking by now, right? The credit markets must be forecasting a massive wave of credit defaults, right? And given the recent weakness in the stock market, the credit markets have to be forecasting a recession by now, right? This chart was pulled off of Fred on Friday, September 22nd. This is an extreme look, but a good example of the look that we would want to avoid. When credit spreads widen out, it tells you that default probabilities are increasing. Economic fear is increasing. How did the same chart look in 2022 when stocks were falling? This is January 2022 here. Here's the peak in late 2022. How does the exact same data set look after another red week in stocks? The answer? The chart speaks for itself. And the typical rebuttal would be, this chart can change rapidly, and that is true. You could have said that here, 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 and here. Hence, why we trade the data set in front of us. Not making any predictions about what this chart is going to look like next week or in 3 months, but there's no question that this sides with the longer-term bullish case. And yes, interest rates have been rising and rising significantly, but that's not particularly surprising. It's really what we're expecting. You can make an argument we're completing the third step for a probabilistic trend change this week. Step 1, we break a trend line. Step 2, we make a higher low relative to either this low or this low. Step 3, a higher high. This is high yield, read riskier, JNK, relative to more conservative and lower yielding IEI, an ETF that consists of U.S. Treasury bonds with 3 to 7 year maturities. This is what risk off looks like in 2022. This is the logical progression since the stock market bottomed in Q4 of last year. Last year we were very, very close to a full bore bearish look. Even with recent givebacks in risk assets, we are very, very close to a full bore bullish look. A lot of charts that look like this, a breakout and the potential for weakness as a test of that breakout. So we have to be open to risk assets falling further, but making a stand somewhere in this area. One of many scenarios. How about this chart covered in detail here? Does it look like the transition from economic confidence to economic fear? It does not. It looks like a bullish breakout that still has some room, risk-off room, to come down and retest that bullish breakout, telling us to keep an open mind about further downside in the stock market. Chart of IEF 7 to 10-year treasuries on your screen as of Thursday's close on September 21st. IEF was trying to bounce back during Friday's session intraday. It's still holding and bouncing around this important level here that tells us to keep an open mind about the possibility of a counter trend move in interest rates, meaning the 10-year yield possibly could fall. A diversified basket of bonds read riskier AGG relative to IEF. This is what the COVID fear spike looks like. The ratio falls, much like the stock market. This is what the ratio looked like after Thursday's sell-off, printing a new 52-week high. This speaks to this, and this. Something we've talked about in the past. There's a lot of debt in the system. Interest rates are rising, and thus debt service payments for the U.S. government going up. How concerning. And is that debt service burden unprecedented? This is where we are today. Not materially different from where we were in the early 1980s. If you know your market history, really good things happened between 1982 and the year 2000. How about the data sets used to declare a recession? Pull them today. They look fine. Typically, people losing their jobs is the first step in the journey to a recession. In fact, if you look at this chart objectively, initial jobless claims 1967 to 2018, typically, before a recession, not shockingly, people are losing their jobs. If we look at the exact same chart and look at it relative to the trend over the past 3 years or so, are we seeing a concerning move like this or this? We are not. In fact, the short-term trend has been favorable. This really doesn't look anything like the lead-ups to these shaded areas here. Like anything else, this may start to move very, very quickly. It hasn't started to move yet. After the recent weakness, the S&P 500 must be in a downtrend, correct? It's a chart that we reviewed in August. Said if the market was going to backtrack, this is an area of potential support, and this would be an area of potential or possible support. How does the exact same chart look this week? And while it's not particularly material to our time frame, we don't even have a bearish cross yet relative to the 10-week moving average in blue and the 20-week moving average in red. That would be a minor yellow flag relative to our time frame. And this is as of the close on Thursday, and we still have this area of potential support relatively close by, and this area of potential support relatively close by. If we take it out a little further, 30, 40, 50-week moving averages, this is a confident look relative to the longer-term probabilities. If we were to view this chart in an objective manner, it's very difficult to say that the look as of the close on September 21st is concerning. And even if we don't hold this region in here, and I would say the base case is that we will not hold this region, there's potential support between 42.18 and 42.03. And all of this is taking place above an upward sloping 200-week moving average, which looks like a secular bull market. On the daily, it seems almost inevitable that this is going to act as a magnet, this gap between 42.41 and 42.32, something that we noted on Twitter several weeks ago. That gap is in the same general vicinity of the upward sloping trend line in blue, and the 200-day moving average, the upward sloping 200-day moving average in red. Markets like to overshoot, so nothing says that price can't get into this area here as well. This is where concerns would increase significantly if you take out the March low. Another look at a wide band of potential support in here, volume by price. And if we removed price and just looked at the moving averages between the 50-day and the 200-day in orange, it'd be difficult to classify this as a concerning look. We have numerous reference points in the general vicinity of price. 200-day at 41.89, pivots at 42.60 and 41.88. We've got these crossing black trend lines inside of the blue box, right around 4,000. And in terms of giving the bullish case the benefit of the doubt, it's relatively easy to do as long as these weekly anchored volume weighted average price lines act as support, and that is to be determined. This region in here around 42.15 down to this tight band here around 41.22. These lines were relevant. What once acted as resistance, 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 what once acted as a stall, may now act as support. And notice, the word may was used numerous times. It's not a good look from a shorter term perspective, telling us we shouldn't be shocked if we go down and test some of these areas of potential support. Got a monthly pivot at 42.43. Price made a stand here near the 200-week moving average in 2011, did something similar in 2016, made a stand near an upward sloping 200-week moving average in 2020, and again in 2022. At this stage, not an alarming look from a longer-term perspective. And if you're a longer-term bull, for the most part, you never want to root against your positions, but all things being equal, really prefer to see this gap getting tested. Notice the look of the 50-month moving average and the 85-month moving average in here when the trend is uncertain. Notice the look when the trend is strong. There's nothing here from a longer-term perspective that's particularly concerning. That would change if price comes back down into this area here. In this segment, we will quickly update charts that we covered in detail on August 11th. The strongest period of this secular bull market looks discernibly different relative to the rollover period and the subsequent loss. Thus, it might be helpful to ask and answer, does today look more like this or this in the lower left-hand corner of your screen? And the answer today and the answer walking forward can help us with these questions. 2011, we get a strong rally off a low. We exceed the moving average envelopes, then there's some give back. 2016, we rally back above the moving average envelope, and then we have some give back. Similar situation. 2020, rally above the moving average envelopes, and then we have some give back. It's a monthly chart. We really don't know what it's going to look like until month end. This is what it looked like as of the close on Thursday. There's no question this looks more like this, and this relative to this. Similar concepts, different chart settings. All of these used in the secular trend model, which is still under development. This is the look we want to avoid. This is the look we want to embrace. This is the look of the same chart this week on September 21st. Let's provide some additional context. This allows us to compare the concerning looks relative to the improving looks. This is what the exact same chart looks like today. This is the 1982 to 2000 secular bull market. If we look at the same chart during the 1950 to 1968 secular bull, very, very similar. Concerning look, constructive look. Same chart in September of 2023. Similar concepts, different settings. During the secular bull, the market makes a stand, makes a stand, makes a stand, makes a stand, which is significantly different from the rollover look. This is what September of 2023 looks like. We believe we could potentially be in this window here from point A to point B. Look at all the volatility that occurs above the upward sloping moving average envelope. It's hard to make an argument that thus far this looks overly concerning relative to all of this. If this strong trend look at the slopes of the moving average envelope, morphs into something like this, then we'd have to reassess the probabilities. And that is the purpose of the secular trend model. And remember, we said there were a lot of worries about a recession with this look here in April of 1989. And before the recession became meaningful, the S&P 500 tacked on an additional 16.7% on the monthly chart. In the wake of the 1987 crash, there were a lot of concerns about the stability of the financial markets and the stability of the economy. October 15th, 1990. November 1987, how to prevent a new depression. January 13th, 1992, how bad is the recession? In December of 1992, it was determined that the recession ended in March of 1991, telling us the answer to this question turned out to be not that bad. Moral of the story, there are always things to worry about. If the present day chart stops looking similar to this window and starts looking similar to this window, concerns would increase. And that's why you're using multiple inputs and multiple time frames. This is a very long time frame chart. Shorter term inputs would help with this move in here at a faster rate. This, and this tell us something about fragile market sentiment in this window here. A window that featured a lot of volatility. But despite all of the concerns, in the context of a secular bull market, stocks performed extremely well, telling us to keep an open mind about concerns in the present day. There's always something to be concerned about, something to be legitimately concerned about. And if we were to review shorter time frames in these windows, it looks like risk off. But had we reviewed it from a longer term perspective, we might have seen that 1990 and 1987 look similar to 1953, 1957, 1962, and 1966. And after those lows, good things continued to happen within the context of a secular trend, very, very similar to the good things that happened within the context of a secular trend. And while market participants in this window here were concerned about something like this or this, that eventually came, but it was years down the road. And as you can see, the setups in this window, followed by gains, really don't look anything like this or this. And eventually the favorable looking chart started to morph into something that looked more concerning. There's a lot to be concerned about in the present day, very similar to this window here. Also an input for the secular trend model. How is it scoring? Does it look more like this or this or this? Or does it look like this or this? Answer? It's probably fair to say that in the third week of September 2023, this looks a lot more like this, 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 and this, and all of this, relative to this, 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 or this. And as always, the commentary is based on the charts in front of us. The present day chart morphs into something more like this window in here, concerns would increase, and that may happen very, very soon. Head into next week with an open mind. If we were to ask and answer, does it still look like a secular trend? The answer is yes. And if we're concerned about this, or we're concerned about this, and we review this chart objectively, look at the strong trend look of the Bollinger Band in here. The strong trend look of the Bollinger Band in here. It's very, very similar to the strong trend look of the present day Bollinger Band. And the present day Bollinger Band doesn't really look anything like this window in here when we look at the slopes and the proximity of price. The slopes and the proximity of price. The wider band says stronger trend, higher conviction. The narrower band says weaker trend, lower conviction. Thus, if the present day bands morph into something more like this or this, that will be caught by the secular trend model, which can't predict anything like any other model. It just will help us assess probabilities. The point of all of this, we should be trading the facts, data sets, and charts in front of us, rather than what we're concerned about or what we think is going to happen. It's very, very difficult to look at all of the charts that we've just reviewed, including this look here, and say it contradicts everything included here on our website. In fact, it's relatively easy to say all of those charts align with this information on our website. We've talked about the potential for productivity enhancements within the context of a secular bull market. Similar topic covered in this video clip, which you can find via our Twitter feed. Hypothetically, if the NASDAQ came back to this gap area, and more importantly, to this gap area here, and let's say it filled the gap and then it held, hypothetically, all of that would occur above an upward sloping 200-day moving average. If what once acted as resistance does not act as support, it's possible that this band down here could act as support. All of the recent volatility and wild price swings in the NASDAQ on the weekly chart occurring above an upward sloping 200-week moving average. Weakening momentum, MACD, bearish cross, occurs well above the zero line. SPY weekly cloud says this is a counter-trend move within the context of an existing uptrend. SPY's weekly chart checks all of the bullish boxes. It's interesting to note that as of Thursday's close after the big sell-off, that is not the case with defensive staples. Credit markets checking all of the weekly bullish boxes. High yield in isolation. Typically, when you see this on the weekly cloud after this, good things continue to happen, and a low like this typically holds. The price of XLK divided by SPY, still holding above the blue box, still holding above the purple box. This consolidation for the ratio occurring above an upward sloping 200-day moving average. It's another risk-on look from a longer-term perspective that tells us if we remain in risk-off mode for a few more weeks. It's another chart that says this could be a bullish breakout and an eventual retest. So these gaps here on these charts tell us to keep an open mind about the S&P 500 falling further, but potentially holding near support. XLK weekly cloud still checking all of the bullish boxes. IYW daily, wouldn't be shocking if we came all the way back and filled this gap, but there's numerous areas of potential support that coincide with the upward sloping 200-day moving average. From a longer term perspective and assessing longer term probabilities, the look of the 30, 40, and 50-week moving averages, it's a good look, especially after this look. Area of potential support, area of potential support, and a cluster of potential support. Remember these concepts of if risk off continues, we may just be retesting these areas of potential support. Similar look here. We could get a plunge and then a potential reversal. Similar concept applies to the VIX. The VIX could spike up near 20, and what once acted as support may now act as resistance. No predictions in any shape, form, or fashion, but these are just good reference points to be aware of if there's a mini panic in the coming weeks. Similar situation here. If there's a mini panic and more downside, this is an area of potential support. Weekly cloud, Apple still checking all of the bullish boxes. another wide range. Really don't want to be making longer-term decisions within the context of a range. If price exceeds this March low, then we would have a bearish breakdown if that holds. You can pause your video player here. This is from Dean. Here's his Twitter handle. Moral of the story, something that just happened in market-leading semiconductors aligns with a long-term uptrend. Only happened a handful of times. 12 months later, semiconductors up over 20%. It's a median return. 90% of the cases, SMH was higher a year later. For long-term investors, historically, when something like this happens, something that just happened in 2023, typically really good things happen for a long period of time. Is it possible this time is significantly different? Of course it's possible. Is it probable? Not based on history. It's also noteworthy relative to our longer-term objectives. It's not unusual for the signal to be followed by some weakness for up to 6 months. If our objectives are longer term, remaining patient in this window historically proved to be extremely rewarding. It's always helpful during volatile periods to think about our longer term objectives. We can do that by reviewing bullet points from the September 1st video. Based on the charts that we just covered on September 22nd, the primary trend is clearly still up. As noted several weeks ago, wouldn't be shocking if the next 6 months were volatile. And history tells us that tolerating swings will most likely add value relative to overtrading our accounts. If we see a recession sometime in the next 24 months, history says that's not necessarily a showstopper relative to a secular trend. Given what we know today, the 1 to 10 year outlook remains highly favorable. And this week we've seen wild swings in volatility based on concerns about inflation and interest rates. Trend strength model still scoring very, very well. Secular trend model, that's still in development. Scored this during Thursday's session, still scoring extremely well, aligning with all of the concepts and charts that we covered in this week's video. And ultimately, as we covered a few weeks ago, our primary goal is to navigate to the right side of the table. To navigate to the right side of the table. And to get there, historically, you had to endure 100% normal and to be expected volatility. Until proven otherwise, the secular trend is the base case. And since it's possible that the charts are going to shift in a material manner, it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.